Hey folks, welcome back to the channel where we cut through the noise on personal finance and economic realities that hit your bottom line. If you're new, smash that subscribe and hit the bell, because right now, the US labor market is hitting the brakes hard. Job openings plunged to just 7.181 million in July 2025, the lowest since September 2024. That's a 10-month skid, according to the Bureau of Labor Statistics' latest JOLTS report. And over the last 4 months, employers added a measly 107,000 jobs total. Yeah, you read that right, barely over 26,000 a month on average. We're talking August's paltry 22,000 gain, July's revised 79,000, a net loss of 13,000 in June, and whatever scraps came before. This isn't a blip, it's a freeze. The Conference Board's leading economic index dropped 2.8% in the first half of 2025 alone, flashing recession risks louder than ever. Unemployment's already ticking up to 4.3% in August, and projections have it climbing to 4.6% by 2026. For anyone grinding to build financial security, this is your wake-up call. Let's break down the freeze. Back in the post-pandemic boom, job openings were north of 11 million, with companies scrambling for workers like it was Black Friday at a warehouse sale. That was the Great Resignation era, quits high, hires frantic, wages climbing. Fast forward to now, and the JOLTS data paints a ghost town. Openings down 176,000 from June to July, hires barely budging, and quits, that key sign of worker confidence, flatlining. The job openings rate slipped to 4.3%, the lowest in nearly a year, meaning for the first time since the COVID crash, there are more unemployed folks than available gigs. It's like the party ended, and everyone's left holding an empty cup. Businesses aren't expanding, they're hunkering down. That surplus of openings that fueled wage growth and bargaining power? Vanished. Now, with openings under 7.2 million for just the second time since late 2020, the power's flipped back to employers. What's fueling this chill? Tariffs, my friends, Trump's trade war reloaded. Since January, those duties have spiked costs on everything from steel to semiconductors, forcing companies to rethink expansions. Import prices up 25 to 50%, supply chain snarled, who wants to hire when your margins are getting torched? Add in retaliatory hits from China and Europe, and you've got delays that kill momentum. Manufacturing seen openings drop 12% year over year, retail's trimming back as consumer spending wobbles under higher prices. The ripple? That anemic 107,000 jobs over 4 months, healthcare scraped by with 31,000 in August, but sectors like wholesale and manufacturing shed 12,000 each. It's not just blue-collar, tech's laying off as AI hype meets tariff realities on chips, and services are cooling with fewer gigs in hospitality. Zoom out, and the Conference Board's lay tells the full story. That index, a cocktail of stock prices, building permits, consumer expectations, and more, tanked 0.3% in June, capping a 2.8% nosedive for the first half of the year. It's the steepest drop since the early pandemic scramble, and the diffusion index, measuring how widespread the weakness is, sits below 50, triggering their recession signal for the third straight month. Consumer confidence? In the toilet, with expectations hitting lows not seen since the 2008 crash. New manufacturing orders? Down. Jobless claims? Climbing for the third month. Even with a stock rally propping it up a bit, the lay's screaming slowdown. They don't call it a full recession yet, GDP still projected at 1.6% for 2025, but the writing's on the wall, growth's decelerating, and tariffs are the accelerator on the brakes. Now, the kicker, those massive revisions shaking things up. The BLS just dropped a bombshell. Preliminary data shows 911,000 fewer jobs added from April 2024 through March 2025 than we thought. That's nearly a million phantom positions, the biggest downward tweak since 2009, slashing average monthly gains by 76,000. It means the labor market was weaker all along, hiding in plain sight behind survey lags and birth-death models that overestimate new business hiring. Over the last year, what looked like steady 146,500 monthly ads. More like 70,500 after the dust settles. This isn't cooked books, it's the grind of benchmarking against real unemployment insurance data. But in this political climate, with the BLS commissioner getting the boot over phony numbers, trust in the stats is fraying, and that uncertainty alone chills hiring more. How's this landing on your finances? If you're employed, congrats, but that stability's shakier than it seems. Wage growth? Slowed to 3.7% year over year in August, the lowest since mid-2024, barely outpacing the 3.1% core inflation creep. Your raise might cover the grocery hike from tariffs, but not much else. For savers, it's a gut punch. Lower job growth means softer consumer spending, dragging retail and services, sectors that employ 80% of us. Your emergency fund? Stretched thinner as healthcare costs rise without the buffer of multiple gigs. Investments? Volatility City, S&P's jittery on recession whispers, bonds yielding 4.5% as Fed cuts loom, but your 401k takes hits if manufacturing, 15% of jobs, keeps bleeding. The side hustle crowd feels it worst. That freelance boom? Fading fast. With businesses pausing hires, contract work dries up, no new projects when expansions are on ice. E-commerce sellers? Margins crushed by import duties, turning profitable flips into losses. Gig drivers and delivery folks? Fewer orders as corporate travel and dining out cool. Even creators and consultants, demands down as clients tighten belts. The net effect? Income streams narrowing just when costs climb, that $2,400 turbulence tax per household from Yale's estimates. And for the jobless or underemployed, it's brutal. 6.4 million want work but aren't counted as unemployed because they stopped looking. Long-term unemployment's up 20% year over year, skills rusting while bills stack. Projections don't sugarcoat it. Deloitte sees unemployment at 4.6% in 2026, with private sector hiring moderating as federal cuts bite. The Fed's eyeing a 4.5% average through 2026, but with tariffs escalating, some economists whisper 5% if retaliation ramps up. CBO's a touch rosier at 4.4% by mid-2026, but even they admit softening conditions through 2027. Either way, it's a climb from today's 4.3%, meaning more competition for fewer spots. Entry level? Forget it, companies want experienced hands to weather the storm. Mid-career switchers? Facing gaps wider than ever. This freeze isn't forever, but ignoring it is financial suicide. The labor market's evolution demands adaptation. Clinging to yesterday's skills is like driving a flip phone in the smartphone age. Upskilling isn't a buzzword, it's your hedge against the downturn. In a world where AI's reshaping roles and tariffs are forcing reshoring, versatility pays. Fields like tech integration, sustainable logistics, and data basics are bubbling up as needs shift. It's about broadening your toolkit to match the flux, not chasing every trend, but building resilience so when openings thaw, you're not scrambling. Think bigger, this is a pivot point for personal wealth building. With growth stalling at 1.6% GDP, traditional paths like climbing the corporate ladder get bumpier. Diversifying skills opens doors to hybrid roles that blend industries, less vulnerable to sector slumps. It's the difference between treading water and swimming upstream. And yeah, the mental toll, job hunts dragging months, rejection fatigue, that's real, eroding confidence and spending power. But spotting the freeze early? That's your edge. Wrapping this up, the labor market's in deep freeze, 7.181 million openings at 2024 lows, 107,000 jobs in 4 months, lay screaming risks, unemployment eyeing 4.6% in 2026. Tariffs, revisions, uncertainty, it's all converging. Time to upskill? Absolutely. Your future self will thank you. Drop a comment, how's the job hunt treating you? Like if this lit a fire, subscribe for more raw econ breakdowns. Stay vigilant, build smart, we'll talk soon.